Traders operating small businesses here in Kenya start paying a 3% tax on their sales to the Kenya Revenue Authority from this month. This, of course, follows the reintroduction of the levy in the Finance Act of 2019. Now, Kenya's President Uhuru Kenyatta signed it into law last November 7th, reintroducing the turnover tax for businesses whose annual sales are below $50,000, and that was in order to boost tax collections in the country. Well, let's take this all apart. We're joined by Nikhil Hira. He's a tax partner at Bowmans Law. Great to have you on the show with us, Mr. Hira. Well, let's talk about how Kenya is heading into this year in terms of taxes. A lot of new taxes on hand. Of course, we talked about the turnover tax at 3% of revenues. At the end of 2018, we saw that contentious 8% VAT on petroleum products, amongst others. Do you expect further changes to Kenya's tax code this year?
There almost certainly will be. There are every year. And I think the problem that we're seeing with the government today is that they're so behind on their collections that they're inventing new taxes as they go along. But let's go back to this turnover tax because there's been a lot of debate about it. I think the first thing to say, it's been in the law for many, many, many years. It was designed to catch those people with a turnover less than around about $50,000 or 5 million shillings. And these are the people that generally are in the informal sector. And the idea was you just pay 3% of your turnover, no further tax, no other returns to file, that's it. Last year, so Finance Act 2018, or 2 years ago now, they abolished it and introduced this tax where they said pay 15% of the business permit that you pay the counties.
Right.
Now that to me didn't make a lot of sense because the idea of the turnover tax was presumably to go after the people who are not in the tax net. And if you've got a business premises and are paying business permit fees, then you're probably already in the tax net because you've given a PIN number and what have you. And I think after a year of doing that, they realized that they weren't really getting anywhere with this, so they've reintroduced the turnover tax. But you continue to pay this 15% business permit tax, except it's now an advance tax which you offset against your turnover tax that you declare monthly. But has it been successful? Not really, because it's very, very difficult to actually police and enforce tax in the informal sector. They're nomadic by nature. You register them here today, they're there tomorrow, and you'll never be able to catch up with them. So I'm not convinced the turnover tax is actually going to hit the numbers and increase our numbers significantly during the course of 2020.
Well, another new tax that Kenya's government is bringing on is they're going to start levying new taxes on digital markets going forward, or online commerce. Now, give us a sense of what kind of firms will be targeted, how that implementation will work. As you mentioned, it didn't work so well when it came to this turnover tax. And could they find themselves butting head with international companies on this new digital tax?
This one is a big can of worms,
right?
This digital electronic taxes and what have you. And it's not just Kenya, all over the world. I mean, you've heard of the Google tax and the Amazon tax and the Apple tax and what that's happened in many parts of the developed world. What they're trying to do here is bring into the net those people that are perhaps offering you services outside the country, but being consumed in the country. So me downloading on my iPad or me using a taxi service and what have you. The problem I think with it is that they've come up with this definition of a digital marketplace, which actually doesn't make a lot of sense. It's quite vague, maybe it was intentional that it be vague so that they bring more people in. But I think it's just going to result in a lot more fighting with the authorities on what is taxable and what isn't. The second thing I think to note is, Uche, that it was supposed to come into force on the 1st of October or later if the President gave assent later, which you said at the beginning was the 7th of November.
Right.
But when it did come into force finally, there was an additional line in the law which said that the Cabinet Secretary for ICT is required to issue regulations for the implementation of the tax. Now those regulations are not there, so the tax is not in a sense in place right now. And in my experience, regulations take up to a year to even come into place. So again, we're It's almost as though we're being reactive rather than proactive in our tax plan.
So some of this not coming on board this
Yeah.
year. Now the government also has indicated its intention to increase other rates, such as the capital gains tax. We talked about the income tax law. Could the current slowdown in growth going on currently in Kenya's economy, is that a deterrent going forward against introducing some of these new taxes?
Not really. I think when we look at the income tax bill, which they issued a couple of years back, I was very disappointed with what they issued because it was simply a consolidation of 40 years of legislation. It didn't actually address the issues of how is business conducted in the 21st century. I think we need a new income tax act, and we need it quickly.
Right.
But it's got to be a good act. It can't be, just hurriedly put onto the table without any stakeholder input, because I think that will just create more problems as we go along. I also think you've got to remember that this has got to go through Parliament. And with the legislative agenda, with BBI, depending on which way it goes, and everything else they've got to do, how high on the list of priorities is the new Income Tax Act going to be? That's something that we've got to bear in mind.
What are your thoughts? Give us a clearer view on your thoughts on that income tax law.
Well, my view was, as I said, they took 40 years of legislation, 1973 all the way up to 2018, I think at the time, and tried to consolidate it. The idea was to make it simpler. Well, in a way they did. The Act reduced from about 130 odd sections to about 60 something. The number of schedules reduced. Yes, it became a little bit simpler, but it didn't go down to the nitty-gritty. I mean, one simple example, the taxation of insurance companies, which has been really confused in Kenya. They simply took what we've currently got, put it in the new income tax bill. That to me is not addressing how insurance companies work today. And I think that's where we're losing out. We're not thinking long term, we're thinking about tomorrow rather than next year, which is an issue for the country.
Well, a lot of this is about revenue collection for the government going forward. What are your thoughts on what we've seen in terms of the targets reached in Kenya's revenue collection targets going forward? 6.2 billion in taxes raised by the end of November. What revenue yield do you expect Kenya to see going forward? And given that we're seeing more and more corporate firms, listed firms reporting profit warnings, is the revised tax revenue target, that's about $16.8 billion, still feasible going forward?
Absolutely not.
In
short, absolutely not. You saw quarter three and quarter four, quarter three at least, economic growth had dropped. I think it came down to 5.1%. There has been a gradual drop in that. So where we've been projecting 6.1% for 2019, if we hit 5.5, I'll be impressed. So that in itself is going to have an impact on tax collections, and we're already seeing that in a way. We've introduced new taxes on, well, not new taxes. We've changed import declaration fees and railway development levy to tax more on finished goods imported. Problem is that we are an import-based nation at the moment. So if you start increasing these taxes, people are not going to spend, and we're seeing that. I mean, you just need to go into a mall in Nairobi. No one is really spending. I mean, spending is very tight. You talk to people, to retailers, how their Christmas was. Most of them are saying we had a bad Christmas, probably one of the worst we've had. And to just nail that home, that 8% increase on VAT, which you mentioned on fuel products, in the first 6 months after that, I understand there was a huge, significant, I think it may have been as much as 20% drop in consumption.
Right.
Which means not only did you not collect the VAT, you didn't collect the corporate tax because the oil companies were not making their profits. You didn't collect road maintenance levy. You didn't collect excise duty. So, it's been proven. Raise the taxes, the chances are the collections will go down.
Right.
We've seen it in our own country. In the 90s, early 90s, we had a top rate of tax of 65%. In fact, for some individuals, 83%. Brought it down to 30%. Look at the collections. It was a 45-degree linear line. So reduce the tax rates, and I think you'll get more. But this business of, introducing a Robin Hood tax which didn't come in, it just makes no sense. It suggests no long-term thinking, which the government really needs to do.
And we're not likely to see the government doing any of that going forward.
I don't think so, unfortunately.
Well, we do have to leave it there. Thank you so much for joining us in the studio. Of course, that was Mr. Nikhil Hira. He's a tax partner at Bowmans Law.